last week we did a recap, and that recap, we were understanding financials, reservations to move in. So we did a summary of some of the prior weeks and we rolled it all up and we looked at from reservation to move in and we stacked that against, the financial statements. So we wanted to see each of the activities that you all are doing in those different workflows, reservation workflow and the move-in workflow. We looked at how it shows up on the financials. So when we interact with the balance sheet, when we're doing reservations, when we interact with the profit and loss statement, we're moving residents into the property management system. We took a good look at how that looks on the financials. So that's one of the things that we want to do on this call. It's not just going through the processes and doing them. It's easy for me to bring up the actual property management system, and then we go through the technical pieces of putting in charge of doing that. There's a place for that, but this, we want to touch on, in addition to that, the context and why we're doing this, and what does it look like, and how can you help me increase my business IQ, and how can you help me understand what's going on the financial statements. Those are the things that we want to draw out of this support and this training to really connect the dots. So this week we're going to look at just walk the example a little further and talk through monthly revenue. We're going to have some monthly revenue discussions and look at the activity on the P&L. And so we're going to, once we have residents into the building, obviously we got to do monthly billing, and there's some other things that take place, quite a bit of things that'll take place. We'll look over the next few weeks to dive into some of those things. We have the balance sheet income statement, and then we have the example of a ledger here. And what we've been talking through is, from our last scenario, we have reservation to move in. We've got all the things that take place from just recognizing community fee without an incentive, and then recognize community fee with an incentive. Okay, and so we'll pull that forward, and we'll look at, let's start getting some billings going. Okay, so this is the next scenario, still same balance sheet, same P&L. We're not going to look at the ledger here because we are going to look at some additional billings, and we're going to have multiple ledgers. So the point of this video is to look at some monthly billings, talk through the incentives and the importance of putting that in at the time of move in, and then having some fun and looking at some scenarios where the incentive was not put in at the time of move in, and then it wasn't recognized until a few months later, and there's obviously some conversations around that we want to look at. Okay, so let's walk through this once again, from checking a resident ledger, moving in, get the billing in. We're going to post charges, just so we take it from the beginning, and we're recognizing the revenue for that first month, and then we're recognizing that community fee, and in this case there was a concession, right? And we can play with this because no matter what the concession is, our example is going to account for it. So if we did give a full community fee concession, then that would be recognized here. Notice that means that there wouldn't have been any cash in the bank, because that means they did not put a deposit down at the time they were going through the reservation process. We just allowed, that was the incentive at the time, and so now they just move right in. And so when you do have that scenario, even though there's a wash, we still want to show that, which is why we still recognize the full 2,500. In this case, we would recognize the full 2,500 incentive, hence the fact that the resident did not pay anything until they pay the prorated rent. And so when they do that, deposit into the bank, pay the prorated rent, now the only cash that we have in place is that, because they got a full incentive for the community fee. Okay. And then from there, right, we would go into, we're going to build the next month, right? So, I want to stack some scenarios in place. So we got a profit and loss statement that's going to look at, we've got a monthly profit and loss statement. So we got July, August, September, and October. And we like P&Ls like this because we can identify trends. In addition to analyzing the P&L against a budget, and we have a budget versus action, we can look at variances. This is good to identify trends and see things that are missing, especially on the expense side. So in this case, we billed for the month of August. And so we know in our space, typically we're going to bill anywhere from the 20th to the 25th, right? So July 20th, July 25th-ish, we're going to bill for the next month. So we would bill, that's going to hit the ledger. So you see we had some additional residents that moved in, which is what the scenario is going to talk about, which is why we got more income. So for this first resident, assisted living, right, there was prorated in July, which is what our previous example showed. Now we got the full month billing in the month of August. So that's the full month. We also had a memory care resident come on. And so in this example, that came on the beginning of the month. So we got a full billing there. And then we got a full billing for an independent living resident that came on, and again, full month billing there. So if we had 2 additional move-ins, we got a community fee that we want to recognize for those 2 move-ins. So going with our same scenario, $2,500 per community fee. So that's why that is $5,000. Again, just understanding what the financials look like. And so when we did the billing and did the move-in process for these 2 additional residents, then we're going to show the community fee income. And obviously we would have had the interaction with the balance sheet as well at the time of reservation. So we've already kind of covered what that looks like. And then in this case, we also had an incentive that we put in, and it was an incentive for this first month. And since it was a full month, we've got a full incentive, which is why we have the corresponding incentive there, bringing this down. So this resident, we wouldn't get a check from this resident until the following month when we bill. So I'm going to circle back to that, but we've got an incentive right up front. We did it at the time of move-in, and we've recognized it in the month that it applies to, which is important. So we've got gross revenue, but then we got a net revenue of the 17.5 because we got the incentive. Okay. Now we're going to look at, we're going to do a next month billing. Okay. And yes, obviously AR is growing, and we should have been collecting checks, right? So we don't want to get in the situation. We've billed August and we billed September. We still have no checks. But the purpose of this example is to look at the monthly billing and talk through a couple things. So, you figure August 20th comes, August 25th comes, and we look to bill September. In this case, we billed September. Well, we're pretending that we didn't have any additional move-ins, so there was no community fee income to recognize. No incentives. So we are able to get residents in the door, no incentives there. So we've got a gross revenue that matches our net revenue because we don't have any incentives. And so that's the next month billing. We know throughout the process when we have residents that move into the building, you're going to have all, other things that come up. You're going to have ancillary charges that we would put in. We can dig into things like that in the next video, but that's pretty straightforward. So that'll be some of the manual charges. You're going to have room unit transfers. We're going to look at rate increases, right? So those are other things that are going on while the resident is moved in, and things that we can also look at in this case, and similar impact to the financial statements. Okay. And then again, while we're not in this example showing AR being paid, so we know how the financial statements, how we read the financial statements. Obviously, as we're billing these charges, the AR is going to increase, right? And you can see that. And we say, okay, well, we've billed a total so far of 36,000. Show me what that looks like on the balance sheet. Well, that's the cash that we've collected plus the AR that we haven't, plus the cash that we have not collected, and that's that total. And that interaction is going to stay consistent no matter what set of financials that you look at. Is that if the accounting is intact, right? It has to be reflected throughout the financials. So out of the $36,000 net revenue that we've billed through AR, right, we've collected $3,000 so far. Okay, and that's how we would read those financials, and which is why our equity, our retained earnings matches as well. Okay, so now let's gonna bill another month, right? We bill October, right? We got the monthly billing again. We know that if we're doing things the right way, we're going to be collecting the AR each month. But we billed October, so we got another month billed. And now we have a total of $51,000 billed. But my example, what I want to dig into is, let's say we, for whatever reason, miss putting the incentive in. So say the incentive should have gone into August, but for whatever reason, going back to why we want to capture it at the time of move-in, going back to why we want to understand what incentives that we're given, being on the same page with our sales leaders and making sure that the incentives that they have in their toolbox that has already got the proper approval and they know the incentives they can use, business leaders, we truly want to know and understand that and make sure that the language aligns. So what they're telling the residents and what comes back on the lease agreement or whatever that, the documentation is going to capture the incentives on our end. When it comes to the business office, we're able to interpret that and know how to make the financials reflect, right? We've seen plenty of instances where seems like a little gray area where the incentives are given and then some of the business office leaders are not able to determine what the intent was behind the incentive, or maybe it wasn't clear. So we want to make sure that we're able to close the gap there. But just to put it in financial, perspective and a viewpoint, if we missed the incentive in August when it was supposed to be recognized, and many times it may be from a resident that looks at their ledger and say, hey, wait, I thought I was supposed to have free rent or something like that, or it comes up or the business leader remembers, that's going to impact a future period where we see that now. And let's just pretend like this was an incentive that should have been done in August, but we didn't do it until October. Now our October P&L, and I know we're just showing the revenue, is going to take a hit when that hit should have been absorbed in August. Right, and I just want to kind of bring that to the forefront. So in August, we reported revenue of a little more than 20,000. So we really have overstated revenue, like, oh yeah, that's great. And then a couple months later, now we have to recognize incentive because it wasn't done at the time of move in, and it was something that we had to go back and remember. And there's a lot of things that are going on, and we go and put that in. And now that our total revenue has to take a hit. So when really we were looking to report 15.5, we've got to report 12.5 because we got to show that incentive to give the resident the appropriate credit on their ledger. 3,000 may not seem like a big deal, but know that this is going to be a community where there's going to be a lot of residents there. So these numbers are going to be a lot bigger, and a couple of those missed, and that's a big impact. And even this in relation to what the total revenue is a big impact. You can easily say, okay, maybe that incentive was really for memory care, right? Now that's a huge hit when really we wanted to capture it in August or whenever it was appropriate. If we missed it in August and then captured it in October, then again, that's something that's got to be explained, because that's going to be a question like, hey, what happened there? And it's more of a process breakdown where for whatever reason, the incentive wasn't clear at the time of move in. So we went, we had to circle back and put it in. And now, ouch, that's a hit to our October financials. So just want to make that example to help make that clear by using some of those numbers so that we can see the importance. And I know you guys understand the importance of being able to capture that, because this is essentially an expense in the period that it relates to, and not blowing up the financials in a later period. Now, again, going back to recording at the time of move in, right? If that memory care resident moved in August, the accounting system, property management system, allows you to go ahead and put that in the queue. So when we do the billing, if this incentive did read, hey, third month free, then when we do the billing, this is how it really would be captured. But that would be captured together when we did the bill. And now we're like, okay, now that goes in, and this is not a result of us having a double back, but the business leader being able to put that in at the time of move in. I can't stress that enough, because that's using the system, allowing the system to work for us, as opposed to going in and have to do a lot of manual charges. My business leaders know that when I do train with them, when I support with them, we're always, identifying where we're going in and putting manual charges, because in most cases, we don't have to put a manual charge in there. Ancillary charges, yes, we may go back and put ancillary charges in, but the billings, that's a click of a button. And if we're using the system as it's designed to be used, then that allows our business leaders to be, frees up their mind where they don't have to go remember, okay, this person got that incentive, that person got that incentive. Let the accounting system work for you. So anyway, in that case, the idea is to show that we can have a move in here as long as we put the incentive at the time of move in. And when we hit the billing button, these two steps together, then we're going to show that that incentive is going to cancel out against the revenue. And that's how we want to capture it. On the flip side, if it should have been here, if it should have been in August, and for whatever reason we had to go back and do it manually, you can see that's a big stain on the revenue, because this number should really be $7,000 higher, but we missed it in August. From a general level, it makes sense to understand that, because it just goes back to when I do things, or when I hear things and I'm talking to my property accountant, I want to make sure I understand that, because it makes you better at your role, makes you better at able to be able to support your president. It makes the presidents better at being able to understand this and what's going on. And that just helps improves the business office, because that's the end goal. Like, we want to have better business offices. And if we can understand the duties that we're doing and how they impact the financials, then I think we're on our way. So that's all I have for today. I just wanted to continue to roll forth that example. We'll get into looking at expenses. We'll get into AP. We'll get into all that. And we'll always look to have the balance sheet and or income statement up as well, so that we can get an understanding of what's going on and what's how I'm impacting the numbers, how I'm impacting the bottom line. Because I think many times we have a general idea, but we can really see and say, hey, when I hit that button and do that, that's what's happening to the overall P&L. Some of you may be involved in the month-end process where you're having to do variance analysis, or maybe your president is bringing you in those conversations. So you're getting some experience there. Some of you maybe not, but whatever the case is, this is going to help just strengthen that understanding, so that you can be more of a value add. Because many of you will be executive directors, and then you see executive directors move into VP of operations positions and on up. So anywhere we can support, we will choose to do so. So anyway, hope that was helpful. Next week, we'll just continue to expand on this. We'll look at maybe some ancillary charges. We'll throw some expenses in there at some point and talk about the opposite side, or down after revenue on the P&L. And there's a lot of things that go into place. There are a lot of things that can trip us up. And so we'll look to continue to dig into that and see, just some best practices and what we can do. Join us next week. We'll be here again next Friday. We'll dig into some more information. We'll love to hear from you guys. This video will end up on YouTube. You can email us if you have questions. If you have questions about the video, if you just have a different issue that we didn't cover, please email us and we'll take a look at it and see if we can help point you in the right direction. So that email is CBO support at TatumAccountingServices.com. CBO is for Community Business Office. So CBO support at TatumAccountingServices.com. You'll have somebody reach out, respond to you if you do have questions. Just give us a try and see if we can help solve your issue. Or just let us know how you like these videos, and if there's anything that you do want us to train on, and we'll love to do so. So once again, my name is Burdett Tatum. I am the founder and CEO of Tatum Accounting Services, where we are here to help support business offices and our operators in the senior living industry. Thanks so much.